to have you back. In this episode, I will look at asset allocation. Why is this important? Well, as intelligent investor, it is very necessary to have at least say between 15 to 25 companies. Diversify companies in your portfolio. And again, why is this necessary? Well, you see, asset allocation is an investment strategy you can employ to balance risk and rewards within your portfolio. Okay, what I'm trying to say is this: you need a balanced portfolio, and you can achieve it through a well-diversified asset allocation. Stay tuned. Let us look at various asset allocations and see what we can include in our portfolio and why. So grab a cup of tea and then subscribe. Remember, our target is 500 subscribers. Moving on. Okay, now I think I should stress this: asset allocation should not be based on the textbook guide. It shouldn't be based on what you read. Why? Because what works for me might not fit your budget and long-term goals. What am I trying to say? Well, it means there is no right or wrong model. However, it is very important to adjust to what you feel best fits your goals and risk tolerance. Moving on, let us look at the portfolio of some of the guru in the industry and compare or see if it's in alignment with our objective goals, if you like. Stay tuned. Let us look at Warren Buffett portfolio. Bear with me. Let me show you. Now, what do we have here? You see, we have the top 5 investment in Buffett holding include his own company, which is Berkshire Hathaway, Apple, Bank of America, Coca-Cola, and Vericom Communication. Stay tuned. Let us look at the breakdown now. Alright, what do we have here? As you can see, we have 90% of stock ranging from large cap to small cap company, and again, it has 10% of fixed income. Meaning this portfolio is very high. Very high risk portfolio, if you agree with me. And then in the last 10 years, the portfolio obtained a 14.03% compound annual return with a 12.22% standard deviation. In 2020, the portfolio granted 1.67 dividend yield. You see, this format, Warren Buffett format or strategy, if you like, work for Warren Buffett, but may not necessarily work for you. You get the gist. If you will agree with me, he has plenty of cash to play around with. At his disposal, and he can at least take some risk. And you and I don't have that kind of money. Okay. Again, let us look at the Dalio all-weather portfolio. Okay, now Thomas Dalio is an American, investor and hedge fund manager who has served as co-chief investor officer of the world's largest hedge fund. World largest hedge fund, the Bridgewater Associates, since 1985. He founded Bridgewater in 1971 in New York City. Stay tuned. Let us relate to Tony Robbins' book titled Money Master the Game, and let us examine the Dalio portfolio. You see, Ray created a diverse asset allocation and named it all-season portfolio. Ray explained how to succeed with the right mix of bonds, equities, commodities, and gold. Okay, that's it. Here is the breakdown of the Ray's all-weather season portfolio, if you like, for the sake of clarity. Let's have a look. Now, what do we have here? We have 30% total US stock market. We have 40% in long-term treasury bonds. We have 15% in intermediate term treasuries bond. We have 7.5 in gold commodities, and we have 7.5 in diversified commodities. Okay. Meanwhile, I'd like you to pay attention to these statistics. You see, say between 1984 to 2003, yes, according to Tony Robinson in his book Money Master the Game. What we have is, this is statistics. We have 9.7 annual returns. You would have made money 86% of the time. Average loss is just 1.9%. Worst loss was minus 3.9%. Though it's very volatile. Okay. You see? Now, what am I trying to say here? You will agree with me that these numbers were very impressive. Okay, now let us fast forward to say 2000 onwards till date. You see, Ray Dalio lost $12.1 billion in 2020. Wow. Though he's still the best performing hedge fund manager of all time now, according to what they say. What am I trying to say here? Well, it looked to me as though there's a paradigm shift in asset allocation, more so in this era. Why? Because of the state of global economy vis-a-vis bad government policies, inflation, fiat money losing its ability to function effectively in our global economy due to excessive printing of money. They call it quantitative easing. Anyway, listen to this good point Ray pointed out during the interview with Tony Robinson. Okay, Tony, he suggested, and I quote, rebalancing this portfolio each year to maintain the original asset allocation, end quote. Okay, now, in my opinion, that probably explains why he now own some Bitcoin. Redilo. Now, listen to this. You see, Ray now I have some Bitcoin. Let me quote him. I quote, I have some Bitcoin, end quote. Dilo told CoinDesk during a 2021 consensus conference. The interview was recorded on May 6. Though he previously expressed concern about the future of Bitcoin, he has also noted that the cryptocurrency earned its respect recently. That said, given the ongoing development in the dynamic in the market, for instance, market environment, where things are evolving constantly, in my opinion, as an investor, you should put the ongoing development into consideration as you build your portfolio. Besides, and this is the key point, you should select and allocate your asset based on your budget and long-term goals. Okay, now stay tuned. Let me share my asset allocation with you. You see, I base my asset allocation on a principle of sector rotation. Yeah, sector rotation. What do I mean by that? Okay, you see, sector rotation is the trajectory of the stock market. You see, the market cycle is embedded with strength and weakness during the general business cycle. And once you can identify the strong and weak sectors, this information is a good tool to help you predict which sector and in what proportion you should include in your portfolio. Which sector and in what proportion you should include in your portfolio. That's what I'm trying to say. So in my case, I have divided mine into 5 sectors. I have the defensive, which I allocate 30%, REIT 40%, cyclical 20%, crypto 5%, yes, crypto 5%, and cash 5%. So question is, what is defensive stocks? Okay, now a defensive stock is a stock that provides consistent dividends and stable earnings regardless of the state of the overall stock market. In other words, they are more stable during most business cycles and risk on or growth stocks. I mean, they are more stable during most business cycles than risk on or growth stocks. That's what I'm trying to say. You see, companies such as Procter & Gamble, Johnson & Johnson, Philip Morrison, Coca-Cola are considered defensive stocks. Stay tuned. Let me break it down with more example. You see, companies like Diageo, the brain behind drinks like Guinness and other similar alcoholic drinks, will always do better regardless of the economy. People will drink. And then we have Unilever and Imperial Brands, okay, right, who produces essential like battery, toothpaste, sanitary pad, etc. You see, during the recent market crash in 2020 and the ongoing inflation, people still buy all this essential. Meanwhile, you should realize that these companies only grow, say, between 5 to 10% per year. Then you should know that the growth is consistent. Next is rate. Okay, now what is a rate? Okay, bear with me. You see, a rate is a company that makes investment in income producing real estate. Investors who want to access real estate can in turn buy shares of a REIT, and through that share ownership effectively add the real estate owned by the REIT to their investment portfolios. Why is this important? Okay, now let me tell you. You see, REITs give consistent returns on your investment, and one of the biggest benefit REITs offer is their high yield dividends. REITs, and then REITs, listen to this, are required to pay out 90% of taxable income to shareholders. In effect, you can use REIT to generate cash flow. And then cyclical stocks. And why? Stay with me. You see, cyclical stocks are these companies that have a direct relation to the economy. What does it mean? You see, investors cannot control the cycles of the economy, like I said, but they can tailor their investment practices and align or adjust them to the economic transition by investing in cyclical stocks. In effect, when the economy grows, price of cyclical stocks go up as well. When the economy turns down, their stock price will drop. That is essential. You must know that. They follow all the cycles of the economy, from expansion, peak, and recession to recovery. With cyclical stocks, you can realize it between 5 to 10% per year. An example are banks like the Barclays Bank, Bank of America, Caterpillar, oil and gas, and energy. Essentially, these large companies sell products and services that are likely depend on the economy. However, you should be aware that these companies make less profit during recession, while they are known to always generate high sales and profit during expansion. And then crypto. So why crypto and why not? Because with fiat money losing its ability to function effectively in our global economy because of excessive printing of money, consequently inflation looms large. There should be a way out, of course, of this mess, and the only viable option, at least for now, is by using crypto as a primary edge against runaway inflation. Besides, the likes of Bitcoin, yes, I mean Bitcoin, are now starting to replace gold as a tool that investors rely on for hedging their portfolio. And then cash. I have 5% in cash. What does it mean? You see, cash is liquid. I can withdraw it anytime to buy more shares and in case of emergency. Now, okay, now, what do you think about my asset allocation? Please write your comment. And would you include crypto in your portfolio? Okay, here comes the best part. Our target is 500 subscribers. For those who already subscribed, thanks a million. Remember, the goal is to generate wealth, build companies, and then create jobs. Bye now. See you soon.